Most people think investing means staring at charts all day, buying random stocks, or trying to become the next Wall Street genius. But here's the crazy part. The investors who often win in the long run are usually the boring ones. Seriously, a simple passive investment strategy has outperformed most professional traders over time. Not influencers, not day traders, actual professionals. And yet millions of people still treat investing like gambling. So if you've ever thought investing is too risky, I don't know enough, maybe I should wait until I have more money. This video might completely change how you see money forever. Most people never learn how investing actually works. School teaches you how to calculate formulas you'll never use again, but almost nobody explains how to make your money grow over time. So what happens? People either do nothing with their money or they jump straight into risky stuff. Crypto hype, meme stocks, day trading videos with rented Lamborghinis. And look, I get it, it's exciting. You see someone online saying, I turned $500 into $50,000 in 3 months. What you usually don't see are the thousands of people who lost money trying to copy that strategy. That's the part nobody posts online. The truth is, day trading is incredibly difficult. You compete against professionals, against algorithms, against people with massive amounts of data and experience. And emotionally, it destroys many beginners. One bad trade turns into revenge trading, then panic, then fear, then more bad decisions. That's not investing. That's stress with extra steps. But now comes the interesting part. There's another way to invest that's simpler, less stressful, and historically very effective over long periods of time. It's called passive investing, and honestly, it's probably the closest thing regular people have to a financial cheat code. So what exactly is passive investing? Passive investing means you don't try to beat the market, you become part of the market. That's a huge difference. Instead of constantly buying and selling stocks, you invest steadily into a broad collection of companies and hold them for years, sometimes decades. The most popular tool for this is something called an ETF. ETF stands for Exchange Traded Fund. Now don't let the name scare you. It's actually simple. Think of an ETF like a giant basket. Inside that basket are many companies: Apple, Microsoft, Amazon, Coca-Cola. Sometimes even thousands of companies, so instead of betting everything on one company, you spread your money across many. That reduces risk massively. Imagine this: you walk into a fruit market. Buying one stock is like buying only one apple. If that apple goes bad, tough luck. An ETF is like buying the entire fruit basket. Even if a few fruits go bad, the basket overall can still do well. That's the core idea behind diversification. And this leads us to something most beginners completely underestimate. You do not need to find the next Tesla or the next Bitcoin to build wealth. You mainly need time, consistency, patience. That's it. Not genius predictions. Now here's where passive investing becomes really powerful. Compound growth. This is basically when your money starts earning money, and then that money also earns money. At first it feels slow, painfully slow sometimes, but over time it starts snowballing. Let's say you invest $200 every month into a broad ETF. Not a crazy amount. If the market grows around 7 to 8% per year on average, which historically happened over long periods, after 30 years you could end up with hundreds of thousands of dollars. Not because you got lucky, because you stayed consistent. That's the difference. Passive investing is less about getting rich quickly and more about becoming financially stronger year after year. But here's the trap. Most people quit before the strategy even has time to work. Because passive investing is not exciting. There are no flashing alerts, no 1000% gains overnight, no adrenaline rush. And weirdly enough, that's exactly why it works. The stock market rewards patience more than excitement. Now, of course, markets go up and down, sometimes a lot. And this leads us to something the majority of beginners misunderstand. When the market crashes, beginners panic. Experienced investors often stay calm. Why? Because crashes are normal. Every major market crash in history felt terrifying in the moment. People thought, this time it's over. And yet over long periods, the market historically recovered and continued growing. That does not mean investing is risk-free. Important point, investing always has risk. But passive investors usually focus on long-term trends instead of short-term panic. Think of the stock market like the weather versus the climate. The weather changes daily. Storms happen. But the climate changes slowly over decades. Day traders obsess over the weather. Passive investors focus on the climate. Okay, so how do you actually start? Let's make this super practical. Step 1. Build an emergency fund. Before investing heavily, save some cash first. Because if your car breaks down or you lose your job, you don't want to sell investments in panic. A basic safety cushion matters. Step 2. Open a brokerage account. This is basically an app or platform where you can buy investments. Nowadays, it's easier than ever. Many brokers even allow automatic monthly investing. Step 3. Choose a broad ETF. For beginners, many people start with broad market ETFs. For example, ETFs tracking the S&P 500 or global world ETFs. These include many companies instead of trying to guess individual winners. And again, this is investing, not gambling. You're buying ownership in real businesses over long periods. Step 4. Invest regularly. This part matters more than timing the market perfectly. A lot of beginners wait forever for the perfect moment. But nobody consistently predicts the perfect moment. Instead, many passive investors invest regularly every month. That strategy is called dollar cost averaging. Fancy term, simple idea. You invest consistently whether the market is up or down. Over time, this smooths out emotional decisions. And I really want to make this clear. Passive investing and day trading are completely different worlds. Day trading is short-term speculation. You try to predict price movements over hours or days. And statistically, most beginners lose money doing it long-term. Not because they're stupid, because it's incredibly hard. Passive investing is based on something else entirely, the long-term growth of businesses and economies. One approach depends heavily on prediction. The other depends heavily on patience. And patience is usually much easier to learn than prediction. Let me give you an example. Two friends start with the same amount of money at age 25. Jake spends years chasing hot stocks, crypto hype, and day trading trends. Sometimes he wins big. Sometimes he loses hard. He constantly checks charts. He stresses constantly. Meanwhile, Sarah quietly invests $300 every month into a broad ETF. No drama. No flashy screenshots. Fast forward 20 years, Jake has crazy stories, Sarah has financial stability, and that's something many people only understand too late. Here's another real-life pattern. During market crashes, many beginners panic and sell everything. Then the market eventually recovers without them. This happens again and again. Emotion becomes more dangerous than the market itself. Passive investing helps reduce that emotional chaos because the strategy is simpler. Buy consistently and think long-term. And maybe the most important example, you do not need to be rich to start. A lot of people think investing only matters if you already have thousands. Not true. Even small monthly investments matter because time matters more than size at the beginning. Starting early with small amounts often beats starting late with huge amounts. So here's the big takeaway. Passive investing is not about getting rich next month. It's about building freedom slowly and consistently. You do not need to become a stock market expert. You do not need to predict crashes. And you definitely do not need to gamble your savings on risky trades. For most people, the smartest strategy is actually pretty boring. Invest regularly into broad ETFs, stay patient, and let time do the heavy lifting. Because wealth is often built quietly, not loudly, and honestly, that mindset alone can already put you ahead of most people. Now I'm curious, what's the biggest thing that still confuses or scares you about investing? Write it in the comments. And if this helped you finally understand passive investing, subscribe for more videos about money, investing, and building long-term financial freedom.